This is the Do-It-Yourself Guide to Business Buying. Today we're talking about valuing the business. Welcome, business buyers. What is our goal with this video, valuing the business? Well, we want to determine the market value of a target business that we want to buy. Before we can make an offer, we need to value the business. There are three main valuation approaches that people use. I mean, there's more, but there's three main ones. There's a cost approach, an income approach, and a market approach. I always find it best to consider them from a timeline perspective. If we're taking a look at one day, let's call it today, we could use the cost approach. A cost approach only looks at a business as of one day. If we're looking at basing the valuation on the future earnings of the business, the forecast, we'd use the income approach. If we're planning to value the business based upon past earnings performance, we would use the market approach. And in fact, professional business valuators often include all three methods in their report. I'm going to only quickly review cost and income, but we're going to explain the market approach in detail because that's the one that's most commonly used when we're doing small and medium business type valuations for the purposes of making an offer. But let's start with the cost approach. It's based on the premise that the value of a business can be thought of as the cost of the assets, i.e., what would it cost us to replace or recreate the assets of the business in an as-is condition. And that's the value of the business. Let me give you an example. The asset list and valuation. Let's say this business has machinery, be $240,000 to replace it. That's the replacement cost. Inventory of $85,000. That's the current market value. Real estate, $500,000, also current market value. Patents of $150,000. That of course has to be estimated market value. Total them all up, $975,000 of total assets. The machinery replacement cost of $240,000 was new, but our current equipment has some wear and tear and obsolescence. So, to talk about what the assets would cost as is, we have to apply a kind of wear and tear charge on machinery. In this case, we call it $90,000. That's a negative number. That adjusts the asset value down from $975,000 to $885,000. Of course, we have to take into consideration the financial liabilities and debt, and we have loans of $110,000 and accounts payable of $40,000. So in terms of total liabilities, negative $150,000. So if we take a look at the net asset value of this business, it would be the adjusted asset value minus the total liabilities, which in this case would be $885,000 minus $150,000. So the net asset value is $735,000, and therefore we would consider the value of the business to also be $735,000. So when do we use the cost approach? Well, two common situations really. Number one, when we plan to liquidate the business. It's no longer a going concern. And whether it's a forced liquidation or orderly liquidation, the point is we're just liquidating the assets. And number two, we sometimes use it when we have a very asset-intensive business and the cost valuation is greater than the valuation we get from the income or market approach. That could be a situation where a business has a lot of assets, but they haven't managed to turn a profit or have positive EBITDA for 2 or 3 years. The business is not worthless. It might have millions of dollars worth of assets. So we would use the cost valuation in that situation. And in fact, the cost valuation is really the floor value of a business. Sellers aren't going to sell it for any less than the cost valuation of the business. But by definition, if we're looking at cost approach, it's typically a turnaround type situation. So we don't really get into cost approach valuations that much when we're buying these small businesses because we do want to buy them as a going concern. But that's cost. Let's take a look at valuing the business based upon future forecasted earnings with the income approach. It's based on the premise that the value of the business is equal to the present value of the future cash flow of the business. Sometimes it's called a discounted cash flow, or if the earnings are quite stable, capitalized earnings, same basic idea. So we take a look at all the cash this business will generate on a net basis in the future. We have to bring it back into today's dollars, its present value. Why? Because $100 received in 1 year is not the economic equivalent to receiving $100 today. That's the time value of money. So what steps are followed in the income approach? Well, we forecast the future cash flows. Then we have to determine an appropriate discount rate to bring them back into today's value. So we discount the cash flows. Then we determine any terminal value. We total it all up. After adjustments, that's the value of the business. And this really is considered the gold standard in business valuations. So why isn't it used more often with small and medium businesses? Why isn't it used more often? Because it requires a future cash flow, which is frequently not available with SMBs. They don't typically forecast out 4 or 5 or 6 years. And besides, it would require us to know the appropriate discount rate. We don't typically know the cost of capital, which is what the discount rate is. in these small and medium-sized businesses, so that also makes it more challenging, and one of the reasons why we don't use it that frequently. Besides, the market approach is easier to understand, it's easier to use, people are more familiar with it, they do use it in real estate. But if you want to base your valuation on the future income stream of the business through the income approach, this is how we would handle it. But we want to talk mostly about the market approach because that is the one we use with SMBs. What's it all about? Well, we're trying to value a business by comparing it to other similar businesses that have recently sold. Keyword is similar. Now that requires a common metric that we need to incorporate as the basis for making these market comparisons. What common metric can we use to compare different businesses? Well, obviously we want a metric that's got a strong relationship with the selling price. Let's imagine we have records for 1 million acquisitions. We want a situation where as the common metric increases, so does the selling price. I haven't determined what the metric is here, but if it's a small number, a small selling price, as that metric increases in size, so does the selling price. And it's nice and linear. And in fact, if there was this beautiful linear progression like we're seeing here, we'd have a great metric. Put in a valuation line, and we could use that valuation line. It would have great predictive value. For example, we could draw a perpendicular from a target co, let's call it ABC, right up to the value line, and then draw a horizontal across to get the valuation for that target co. And we'd have a pretty good feel for what businesses like this have previously sold for based upon that value line. So what are the possible metrics that we can use? Well, there's different options. Let's just throw out a grab bag, revenue, headcount, gross margins, units sold, earnings. How about the number of SKUs, net margins, inventory turnover, fixed assets? Just threw a bunch out there. Let's randomly choose one just to see how this would work. Let's randomly choose the number of SKUs, stock keeping units, the number of items that we have, individual items. If our supposition was going to be true, as the number of SKUs increased, the selling price would increase as well. The higher the number of SKUs, the higher the selling price. And to find out whether it's true, we would look at some transactions, and we'd plot based upon the number of SKUs and what the business is sold for. And if we did it in this situation, as the number of SKUs increase, the selling price certainly doesn't increase to the same degree. And so we'd easily conclude that the number of SKUs has no clear link to selling price and has no predictive value. So we're not going to base our value line on SKUs. That's no surprise. I don't think anybody thought that was going to work out anyway. We just wanted to use it for illustration purposes. We clearly need a better metric. I think intuitively, a lot of people would look at earnings because it seems like there definitely is a relationship, i.e. as business earnings increase, the selling price also increases. The answer to that question, I think, is a big yes. And so we could draw a valuation line with earnings. I won't bother going step by step. We've already done that a couple of times. But there are two things I want to note about this valuation line. While selling price does vary with EBITDA, I don't think anybody questions that. How much it varies or what the multiple should be does change based on different factors. And we're going to take a look at some of those in this video. So the slope of the line or the multiple depends upon this. For every dollar increase you get in EBITDA, how much is the selling price actually increasing? For example, if I have an EBITDA increase of $1 and the selling price goes up by $1, I have a multiple of 1x. That's about what that looks like. I only eyeballed it, but I think it's pretty close. If you had a $1 EBITDA that generated a $2 increase in selling price, now we got a multiple of 2x, that line is going to get steeper. If a $1 increase in EBITDA resulted in a $3 increase in selling price, that's a 3x multiple, steeper still, and we can keep going. If it's 4x, we just make it steeper. So selling price does increase as EBITDA increases, no question about that, which means we've got a valuation formula that looks like this. The value of the business equals EBITDA, the earnings number, and having some multiple applied to it based on multiple historical transactions. The value of the business is the enterprise value. This EBITDA times multiple, it is subject to some adjustments I'm not going to go into here. But the multiple, let's make sure we're clear on that, is the selling price over the EBITDA, but not just for one business, for a group of businesses. We're going to have a data set based on historical transactions to come up with the right multiple. Now, the tricky part is getting EBITDA right and the multiple right, because things can go wrong. Let's recall from the video on financial analysis that when we're valuing with a market approach, we start with ordinary income or operating profit. We add back interest, tax, depreciation, and amortization. That's literally EBITDA. From EBITDA, sometimes we've got to make some more adjustments. We add personal, discretionary, and non-recurring expenses when appropriate to come up with adjusted EBITDA. From there, we're going to add back the total owner's compensation to come up with seller discretionary earnings. That's the link. But please note, you need an adjusted EBITDA number to apply an adjusted EBITDA multiple. They go hand in hand if we want to value the business. If we have an SDE number, we don't apply an adjusted EBITDA multiple. We apply an SDE multiple to value the business. We have to keep those two straight. Now, typically, we're using adjusted EBITDA for almost all SMB valuations. The only exceptions are businesses that are micro, only a handful of employees. Tiny businesses often do use an SDE valuation methodology. Now, what could go wrong? Let's take a peek. There are 13 common mistakes to avoid that I want to look at in this video, starting with using net income and not operating profit when you're doing EBITDA calculations. They put the wrong number in as the base. They use net income instead of operating profit or ordinary income. The problem with using net income is that it includes a lot of non-operating income, which is going to distort the result. So you definitely want to avoid that. Number two, adding back all taxes, not just income tax. When we're doing the adding back, don't add back all the taxes, only add back the income tax. The other taxes are legitimate business expenses. So that's another common mistake you see being made. Number three, owner's compensation number is wrong. When we're making the adjustment from EBITDA to adjusted EBITDA, people don't adjust the owner's compensation. Owner's comp should reflect market rates, period, which means sometimes they need to be adjusted up, sometimes down for various reasons, but the adjustment isn't made, which gives us a distorted result. Next, the lease or rent number is wrong. When we're doing the adjustments from EBITDA to adjusted EBITDA, the adjustment for the rent or lease expense is not made. Rent or lease should reflect market rates. Sometimes it needs to be adjusted up, sometimes down. There's all kinds of different scenarios that can play out. I mean, sometimes no adjustment is needed, of course. But people, if they own the property, will sometimes be light on the expense they charge to try and make the earnings of the business look a little bit stronger. If we find that's the case, we need to make the adjustment. Very often people don't. And so that's something to keep your eye on. Next, including gains on the sale of fixed assets. That's something you have to be aware of. Including a gain on the sale of assets is a mistake. It's not a legitimate add back. The issue is depreciation related. I don't want to get into all of the details here. But if you do notice that the operating income includes a gain on the sale of fixed assets, that's something that we should eliminate when we're making our adjustments. Including add backs on all kinds of different business mistakes. When we're adding personal discretionary and non-recurring expenses, people like to add losses associated with business mistakes. They have an unsuccessful marketing campaign. They spend $20,000 on it. They say, we won't do it again, therefore we're going to add it back. That's not a legitimate add back. And if it has been included, it needs to be adjusted. Next is applying the wrong multiple to the wrong earnings value. Let's recall from an earlier slide that the value of the business is equal to the earnings times some multiple. So we start with the earnings of a target co. We have their financials. We go through the progression, income, EBITDA, adjusted EBITDA, SDE. I'm not going to re-explain it. We have covered this in previous videos. It is adjusted EBITDA that's considered the normalized EBITDA, and that's the number that we collect the data on to come up with industry comparisons. But there are really two multiples. There's an EBITDA multiple and a seller discretionary earnings multiple, or an SDE multiple. And the EBITDA multiple is always bigger than the SDE. And so that can lead to some mistakes. Let's go over them. There's really two issues here that I want to talk about. Number one, if we're using an EBITDA multiple, we really have to apply it to the adjusted EBITDA number that we get from the target co when we look at their financials. We don't apply it to anything else. In other words, if any EBITDA adjustments are needed, they have been made. We've applied the EBITDA multiple to the adjusted EBITDA number from the target co. Everything is the way it's supposed to be. Now, people sometimes ask me, can you use the EBITDA multiple on the EBITDA from the target co? And the answer is if no EBITDA adjustments are needed and adjusted EBITDA is equal to EBITDA, then sure, go ahead. That's fine. That's going to work as well. But here's the mistake that you want to avoid. If you're in a situation where you're applying an EBITDA multiple to the EBITDA of the target co, and there are EBITDA adjustments that are needed that have not been made, that's a classic way to undervalue the business, and we want to avoid that. It's going to make it hard to get offers accepted as well, because you've ignored legitimate add backs when you've determined the income of the business, and so you're applying an EBITDA multiple to, a lower number. The second mistake might be the more serious one, and that is people are applying the EBITDA multiple to SDE. Remember, the EBITDA multiple is the higher multiple, but SDE is the higher earnings number. So this kind of mix and matching is a great way to overvalue the business, but it does happen all the time. I'd say it's even a favorite broker trick. They love the idea of giving you an SDE number from the target co based on their financials and then applying an EBITDA number to that SDE earnings number, right? That mixing and matching, right? Like I said, it's a great way to overvalue the business. So just check to make sure that if you have an EBITDA multiple, that you're using it on adjusted EBITDA. If you're using an SDE multiple, right, use it on SDE earnings. That way we keep everything nice and neat. If you do that, you should be in good shape. With the market approach, historical transactions are tracked. The first transaction, we take a look at the selling price and the adjusted EBITDA. We come up with the selling multiple. We look at the second transaction, the third, the sixth. We fill in the selling price and earnings for all these transactions. For the first one, the selling price was 1.9 million. The EBITDA was 700K. We divide it out and we get an EBITDA multiple of 2.7x. We do the same thing for 2 and 3 and all 6 of them. Then we come up with an average and we say the average EBITDA multiple is 3.4. Are we going to use that EBITDA multiple for historical transactions when we're valuing target co-businesses? And the answer is no. There's a big problem. Why do we avoid averages? Because they're easily skewed by big outlier numbers and can paint a deceiving picture. If we have 15 transactions in a historical data set, we want to use that data to come up with multiples that we can use to value businesses that we want to buy. If we took the 15 transactions, we could take the average EBITDA and calculate the mean, or we could take the middle EBITDA number and determine the median. And the middle EBITDA number is exactly what it sounds like. We take the transaction value where there's 7 values above it and 7 values below it. We call that the median. And with the average EBITDA, we do have to worry about the results being skewed. If we have a couple of deals that have very, very high selling prices, that's going to drag up that average. We don't have to worry about that when we do the median, the middle number. It's not subject to being skewed by outliers. So we don't use average EBITDA. Instead, we use median EBITDA. Now, we're relying on published data sets. We're not collecting the data ourselves. This is not something we have to worry about hands-on, but it is something worth noting. Now, I do want to take a look at a few more common valuation mistakes. The next one is ignoring EBITDA trends when it comes to the target businesses. In our video on financial analysis, we talked about situations where EBITDA is declining year to year. Sometimes it's variable year to year, or it could be growing. Or, of course, the fourth one, the famous banner year, where the year of sale has a tremendously high EBITDA. Does trend affect the EBITDA number we use? The answer is yes. In some situations, we use the recent year, some the 3-year average. Sometimes we use the 3-year weighted average, or we can come up with other ways of doing it as well. Check the video on financial analysis where we go into this in more detail. Number 9, ignoring differences in industry multiples. We could have two businesses that have a very similar EBITDA, but one will have a higher multiple, the other one a lower multiple, based upon their industry. For example, if we have a food service business, they typically trade at lower multiples. We could have a SaaS business with exactly the same EBITDA, but it's going to trade at a much higher multiple based upon historical transactions. HVAC businesses somewhere in the middle. So we do have differences based upon industry. We also have differences based on size. We could have two businesses in the same industry. One would have a higher multiple, the other one a lower multiple, based upon how big they are. 10 million in revenue, it trades at a higher multiple. Only $1 million in revenue, that's going to trade for a lower multiple. When we're talking about public companies versus private companies, we could have two businesses in the same industry, have the same EBITDA, and again, there'll be a difference in multiple based upon whether they're public or private companies. If we have a public buyer and a public seller, they tend to trade at higher multiples. Private buyer and private seller, they tend to trade at lower multiples. So business valuations can definitely vary with respect to industry, size, and public versus private. So you have to be very careful when you're doing these valuations to factor that in. A couple of more before we finish up. Sometimes people ignore the fact that there is a valuation range, meaning sometimes similar industry, similar EBITDA, similar profile when it comes to public versus private, but still one will trade at a higher multiple, one at a lower multiple. What's that all about? Well, some businesses will sell for a premium price. Other businesses sell for a discount price. So what factors drive premium valuations? That's such a big topic that I've got a special video I'm putting together on premium valuation. So we'll cover all of that in that video. And then finally, ignoring that valuation is not an exact science. I mean, sellers can ask whatever they want for their business. There's literally no correct valuation for them from their perspective. That means you want to avoid broker math sessions with sellers and brokers where you get into long, protracted discussions about what the correct valuation is. Those tend to be very self-defeating conversations. We know what we're comfortable paying in terms of an offer price. We can't control what the seller wants. So that's using valuations to make an offer. Let's see how it works with an example. We've got a target co that we want to buy. We know what their adjusted EBITDA is. We take a look at what the industry multiple is based upon historical transactions, and then we value the target company. Let's say the adjusted EBITDA is 900K. That's the earnings of the target company that we're thinking of buying. Based on historical trends and the data set we look at, the multiple is 3.1 times EBITDA. That's what reflects the historical trend. And of course, it's based on industry size, profile, etc., and published data. We multiply them together. We get the valuation for the target co of $2.8 million. That's the value of the business that we want to buy. And so we could potentially offer somewhere in the $2.8 million range for the target co. We could go in less if we think there's some seller distress, but we know roughly what similar businesses sell for, which is the point of the whole exercise. And that is the market approach to valuation. In the next video, we're going to talk about structuring an offer, but let's get after it. This is the Do-It-Yourself Guide to Business Buying. Today, we've been talking about valuing the business because we love to learn and grow as we go. Thanks for watching. We'll see you next time.